This warning from the CEO of the nation's largest automaker, General Motors, about the impact of the tariffs on the car industry. Mary Barra told shareholders the tariffs on imported cars and auto parts will cost GM between $4 to $5 billion this year alone.
Thank you. Stephen, this morning GM is putting a dollar figure on how much the president's tariffs will impact the company. The CEO says tariffs will cost GM between $4 and $5 billion.
General Motors' facility in Oshawa, Ontario, is the latest Canadian auto plant to feel the effect of U.S. tariffs. The plant will be cutting back operations, moving from 3 shifts to just 2 starting this fall.
General Motors, one of America's most iconic car manufacturers, is now facing up to $5 billion in losses, its biggest challenge in years, as it stands at the center of Trump's tariff war. President Donald Trump's ambitious 25% tariff policy on imported vehicles and parts has sent shockwaves through the automotive industry, striking at the heart of General Motors. This $5 billion crisis could lead to at least a $5,000 increase to the cost of your vehicle. But can Trump's hardball trade tactics force GM to abandon its Mexican factories? And at what cost to American consumers? And most importantly, could this radical policy actually bring manufacturing jobs back to American soil? Before diving into the tariff impact, let's understand what's at stake. General Motors isn't just Chevrolet. It's an automotive empire spanning 4 distinct brands that cater to different segments of the market. At the heart of GM's lineup is Chevrolet, the company's volume leader with everything from affordable sedans to powerful trucks. In 2024 alone, Chevy accounted for over 443,000 sales in Q1, up 14% from the previous year, showing its massive importance to GM's business model. Then there's Buick, which saw the highest percentage growth among GM brands at 39% in early 2025. Originally focused on luxury sedans, Buick has transformed into a brand specializing in premium crossovers and SUVs. GMC represents GM's truck and SUV specialist division, offering rugged yet refined vehicles built for capability and premium comfort. GMC's Sierra pickup shares mechanical DNA with the Chevy Silverado, but targets a more upscale buyer. At the pinnacle sits Cadillac, GM's luxury division, which has transported US presidents and continues to serve as the company's technology and innovation showcase, with vehicles like the Escalade and newer electric models like the Lyriq. Together, these 4 brands form a carefully balanced ecosystem designed to capture every segment of the market, from budget-conscious buyers to luxury seekers. But this carefully constructed empire now faces an unprecedented challenge. Here's where the plot thickens. While GM proudly wears its American heritage, the company has quietly become the largest automobile manufacturer in Mexico. This strategic move made perfect business sense in a globalized economy, until Trump's tariffs turned it into a serious liability. The numbers tell a shocking story. Of all the vehicles GM sells to American customers, only 52% are manufactured domestically. The rest? A whopping 30% come from Mexico and Canada, with another 18% from overseas. Compare that to Ford, which produces 78% of its US sold vehicles domestically, and you begin to see why GM's stock took such a beating when the tariffs were announced. It's not just about assembly plants. The modern automotive supply chain is incredibly complex, with parts crossing borders multiple times before a vehicle is completed. A single vehicle might contain components from dozens of countries, making it nearly impossible to create a truly American-made car overnight. GM's heavy reliance on Mexican production facilities in locations like Ramos Arizpe, San Luis Potosi, and Silao has turned from a competitive advantage to a vulnerability. Popular models including the Chevrolet Equinox, Blazer, Silverado, and GMC Terrain are either partially or completely manufactured south of the border. When Mary Barra, GM's CEO, delivered the company's financial forecast for 2025, the numbers sent shockwaves through Wall Street. The company expects tariffs to wipe out between $4 billion and $5 billion in earnings this year alone. Let that sink in. $5 billion. That's more than what many Fortune 500 companies earn in an entire year, gone because of a single policy change. GM was forced to pull its previous earnings guidance of $13.7 to $15.7 billion and replace it with a more modest $10 to $12.5 billion estimate. The stock market responded predictably, with GM shares falling more than 7% in a single day following the tariff announcement in March 2025, far worse than the 3% drop at Ford and minimal change at Tesla. What makes this situation particularly challenging is that GM can't simply absorb these costs. Someone has to pay, and that someone is likely to be the American consumer. Industry analysts estimate that tariffs could increase vehicle prices by anywhere from $2,000 to $12,000 per vehicle, depending on how much of the vehicle is imported. The Center for Automotive Research projects that the tariffs will increase costs by about $108 billion for automakers in the US this year. That's not just a corporate problem. It's a consumer problem that could put new vehicles out of reach for many Americans already struggling with high interest rates and inflation. For everyday Americans, the impact of these tariffs is already being felt at dealerships nationwide. The average price of a new vehicle was already hovering around $48,000 in early 2025 before the tariffs. Adding thousands more could push many potential buyers out of the new car market entirely. The vehicles seeing the steepest price increases are precisely those that middle-class families rely on. Affordable SUVs like the Chevy Equinox and GMC Terrain, both of which are produced in Mexico. These aren't luxury items, but essential family transportation for millions of Americans. What's particularly concerning is that these price increases come at a time when American consumer confidence has already been shaky. According to reports, US consumer sentiment plunged by 32% to its lowest level since the 1990 recession between January and April, after the announcement of Trump's tariffs sparked fears of a global trade war. This drop in consumer confidence has already impacted other sectors, with companies like McDonald's reporting their largest quarterly sales decline since the COVID-19 pandemic, driven primarily by Americans cutting back on spending. In the automotive world, this has created a paradoxical situation. Consumers rushing to buy vehicles before prices increase further, followed by an anticipated steep decline in sales once the full impact of tariffs is felt. Just when things were looking bleakest, GM made a stunning announcement that could reshape America's automotive landscape. In June 2025, the company unveiled a $4 billion investment plan to shift production from Mexico to 3 plants in the United States. This massive investment includes reopening the recently closed Orion Assembly plant in Detroit, which will now produce full-size SUVs and light-duty pickups. The plan represents not just a business decision, but a fundamental shift in GM's manufacturing strategy. We believe the future of transportation will be driven by American innovation and manufacturing expertise, Mary Barra declared in a statement. Today's announcement demonstrates our ongoing commitment to build vehicles in the US and to support American jobs. The move won immediate praise from unexpected quarters. United Auto Workers president Shawn Fain, who had previously been a vocal critic of Trump, called the development a victory for American workers. For decades now, it has not been a level playing field for us automakers globally, he noted, in a remarkable shift of tone. However, there's a catch to this apparent good news. The production shifts won't take effect until 2027, meaning American consumers will continue facing higher prices for at least 2 more years. And the $4 billion investment, while substantial, represents only a fraction of GM's Mexican manufacturing capacity. We're halfway through our deep dive into GM's tariff challenge. If you're finding this information valuable, please help us reach more viewers by hitting the like button and subscribing to the new Diplomat channel. GM isn't suffering alone. The entire automotive industry is scrambling to adjust to the new tariff reality. Ford has announced that tariffs will cost them at least $1.5 billion this year, though they're better positioned with their stronger domestic production base. Last year, we assembled over 300,000 more vehicles in the US than our closest competitor. Ford CEO Jim Farley boasted during an earnings call. In this new environment, automakers with the largest US footprint will have a big advantage. And boy, is that true for Ford. Stellantis, owner of Chrysler, Jeep, and Dodge, has also been impacted, though to a lesser degree than GM. Like their competitors, they've had to withdraw financial guidance for the year due to tariff uncertainty. The tariffs have created winners and losers within the industry. Tesla, which produces most of its US sold vehicles domestically, has seen its stock largely unaffected by the tariff announcement. This gives American EV manufacturers a potential advantage over foreign competitors who now face significant import taxes. Perhaps most surprisingly, the tariffs have created an unlikely alliance between Trump and labor unions. UAW President Shawn Fain, despite previously supporting Kamala Harris in the 2024 election and calling Trump a scab, has come out in support of the tariff policy, saying, "We're in a triage situation. Tariffs are an attempt to stop the bleeding from the hemorrhaging of jobs in America for the last 33 years. While much of the focus has been on domestic impacts, GM's challenges extend far beyond US borders. The company has been struggling in China, once a key growth market. GM sales in China fell 14% in 2024. Continuing a slide that began in 2018, the Chevrolet brand has been particularly hard hit in China, with sales plummeting from 641,320 vehicles in 2018 to just 52,774 in 2024, a staggering 92% decline. This collapse has forced GM to delay or cancel several planned new models for the Chinese market. Meanwhile, the tariffs have strained diplomatic relations with Mexico and Canada, threatening the United States-Mexico-Canada agreement that replaced NAFTA. Mexican President Claudia Sheinbaum has expressed concerns about the upcoming 2026 review of the agreement, suggesting that trade tensions could escalate further. The interconnected nature of the global automotive industry means that tariffs don't just affect cross-border trade, they reshape entire supply chains. As manufacturers relocate production to avoid tariffs, they create new economic winners and losers across the globe. As we look toward the future, the big question is whether GM's $4 billion investment in US manufacturing represents a temporary adjustment or the beginning of a fundamental transformation of its business model. The company has been clear that it sees the tariff environment as a challenge, but also an opportunity. We're going to see us be very resilient and again strengthen our business as we move forward. In some cases, seize opportunities where the vehicles are so successful, Barra told investors recently. GM's chief financial officer Paul Jacobson has suggested that the tariffs wouldn't be as bad as the market reacted to, noting that potential trade deals with other countries and the automaker's ability to mitigate some costs are promising signs. The company expects to offset between 30% and 50% of the North American tariffs without deploying any capital in the short term. However, the longer-term strategy clearly involves reshoring more production to the United States, particularly for high-margin vehicles like SUVs and trucks. GM has also been making significant investments in electric vehicles, with the Chevrolet Blazer EV and Equinox EV representing key parts of its electrification strategy. The tariffs complicate this transition, potentially slowing down the adoption of electric vehicles if prices rise too dramatically. As our journey through GM's tariff challenges comes to an end, we're left with a fundamental question. Will Trump's aggressive trade policy succeed in bringing manufacturing jobs back to America, or will it primarily result in higher prices for consumers? The early evidence is mixed. GM's $4 billion investment in American plants represents a clear win for domestic manufacturing, potentially creating thousands of new jobs. Yet these gains must be weighed against the immediate impact of higher vehicle prices on millions of American consumers. The automotive industry has always been at the heart of American manufacturing, serving as both an economic engine and a symbol of national pride. The current tariff battle represents more than just a policy dispute. It's a referendum on America's place in the global economy and the future of domestic manufacturing. What's clear is that we're witnessing a historic restructuring of one of America's most important industries. Whether this leads to a renaissance in American auto manufacturing or a painful adjustment period for consumers and manufacturers alike remains to be seen. As the story continues to unfold, the new Diplomat will be here to bring you the latest developments and in-depth analysis. The road ahead may be bumpy, but the destination, a stronger, more resilient American automotive industry, remains the shared goal of policymakers, industry leaders, and workers alike. What do you think? Will Trump's tariffs ultimately strengthen American manufacturing or hurt consumers with higher prices? Let us know in the comments below. Before you go, please take a moment to support our channel by liking this video, subscribing if you haven't already, and sharing it with others who might be interested in this important economic story. Your support enables us to continue bringing you in-depth analysis of the most important issues affecting our economy and society. Thank you for watching, and we'll see you in the next video.